MD of Corporate Banking at Diamond Bank, Uzoma Dozie. Thank you so much for joining us to talk, of course, to unpack your Q3 numbers, which on the top line we continue to see steady growth from Q2 to Q3. Can you just give us a sense of what's driving that growth right now?
I think what's driving it is the business strategy that we've embarked on. We're still a strong player in the middle market, and also our play in the retail space is helping us, first of all, reduce our funding base. So it's quarter Q on Q has been gradually going down. And we're also playing in the market where we can still capture yields of, that gives us a strong net interest margin. So basically, it's the business of it's low-cost funds. Our operating expenses are actually been going down quarter on quarter, which has also helped stabilize our profits. So we are seeing very good operating income across the quarters.
Okay, obviously, like you mentioned, you are seeing higher interest margins there. And of course, there is the growth of your retail loans, which was up about 59%, if I'm not mistaken. But give us a sense of what's going on with the non-interest income. We've seen that come down relative to the numbers last year.
Well, as you know, there was a lull in lending, and lending also drives fee-based income. But if you dig deeper into the numbers, what you will see that at this stage of the business, we've actually seen a higher fee income per lending than we've seen in history. So we will see this trend continue to grow as our risk assets climb up.
Okay, and then let's get a sense of your balance sheet. We see deposits lower quarter on quarter, loans increasing. Obviously, your loan-to-deposit ratio is rising up. Can you give us some insight into why we're seeing this trend?
Well, I think one of the things we're driving for now is efficiency. And if you look at our balance sheet, if you compare our balance sheet Q3 to Q3 2009, what you'll see is a very efficient balance sheet. Our operating income is actually higher now than it was, although from a gross earnings of about 84 billion last year, we made about 53 billion. And we're doing that same amount with gross earnings of 67 billion. And so the deposits that we are losing are high-cost deposits. The deposits that we have are low-cost. So our low-cost deposits, the total deposits, have actually grown significantly. And so although deposits have dropped, we're in a better position, and we have a very good, solid platform for growth.
And then what about on the loan side? Like I mentioned, that was up. Is that really a story around the growth of your retail loans?
It's a combination of, the retail loans are, because we're starting from a lower base. So a growth of 59% is still small and not where we want to be. But also where our strength is, the middle market, is where we're also growing to, and the yields there are good. So the loans, we are capturing, we're growing our loans where we want to grow them. And we're getting the rewards for that.
And then, of course, the higher provisions for non-performing loans is up from 5.5 billion to 12 billion. What's the story behind that?
Well, the loans we're providing for are legacy loans, which predates the 2009, before the crisis. And so these are also loans that are fully collateralized. So it's a business decision. Do you repossess or do you take this provision? And so we have taken the option to make these provisions while we actually we go for the collateral.
Okay, and then cost to income, that is coming down steadily. It's down to about 64%. And where are you really making the gains there?
Well, I think we're making the gains across the whole business. And like I mentioned in previous interviews, we embarked on an exercise to actually optimize our business, and that was coming from how we operate. So I think we're centralizing most of our processes, which means that we have less people in branches doing processing. We are optimizing our sales force. So we have, if you look at productivity in terms of salespeople, it's up. If you look at the cost per location, it's going down Q on Q, and also the cost of processing is much lower now. So it's a strategy that we're continuously implementing, and it's paying for itself.
It's obviously paying off. Okay, very quickly now. rescued banks, last time you were here, you said you had interest. Have you put in a bid for any right now?
No, we have not put any bid to any banks right now. I think we're driving our business on an organic path at the moment. But if we do see opportunities in the market which will help us meet our strategic objectives, we will definitely look at it. But right now, the rescued banks are not in our purview.
And with that focus on organic growth, what are your expectations for the fourth quarter? Obviously, there has been a lot of talk about slow growth in lending in the marketplace. What are the key expectations that you hope to deliver to analysts come the end of Q4?
Well, in terms of driving the business, we're very optimistic. Q-on-Q loans grew by 5.6%. We have a lot of loan requests and approvals in the pipeline, which should come into the books in Q4. Our cost base is our funding base is still very, very comfortable, and we're still driving our low cost strategy, which is working, and we have propositions that will help drive that. So Q4 and of course OPEX is still on a downward trend. So we're very optimistic about Q4 in terms of the operating business, and we expect to see better operating profits as we have seen in the subsequent quarters.
And I'm sure many shareholders will be looking forward to that. It's been a challenging year, but thank you very much for joining us
Thank you very much
on the show.